Welcome to the students of MBA, Dr. B.R. Ambedkar Open University, to this lesson. This lesson is on monetary policy, which is a part of business environment. Every country will have macroeconomic policies to ensure economic growth and price stability. The objective of these policies is to achieve a balance between demand for and supply of goods and services in the economy. This balance ensures the price stability and economic growth. There are several definitions of monetary policy. Some economists said that monetary policy influences the aggregate demand of goods and services in the economy, and this is done through money supply and interest rates. Some other economists felt that monetary policy aims at achieving full employment level through expansion and contraction of money supply. Some other economists felt that the monetary policy aims at achieving a stable interest rate regime by influencing the supply of money. However, a comprehensive definition of monetary policy is given by the economist C.K. Johari. According to him, monetary policy comprises those decisions of the government and RBI which affect the volume and composition of money supply, the size and distribution of credit in the economy, the level and structure of interest rates, and the effect of these variables upon the factors determining the output and prices. Let us understand this definition. According to this definition, monetary policy, unlike some other policies such as trade policy, industrial policy, etc., is not a written document. It comprises of decisions of government and RBI that affect the following things. The first one is volume and composition of money supply. So, money supply means all cash in circulation and in the form of bank deposits. For example, in India, there is about 33 lakh crores of cash in circulation and about 188 lakh crores in bank deposits. This volume of money supply can be influenced by the central bank through its decisions. The second aspect of the definition is the size and distribution of credit. So, including the credit given by cooperative banks. This size and distribution of credit depends upon the size of deposits and other decisions of the central bank such as open market operations, reserve requirements, etc. About open market operations and reserve requirements, we will discuss when we discuss about monetary policy instruments. And the third one is the level and structure of interest rates. So, the central bank of a country reviews the interest rates periodically and take decisions on the change that is required in them depending upon the inflation rate, growth rate in the GDP, etc. So, these decisions regarding the inflation, regarding the liquidity, regarding the structure of interest rates, etc., impact input and output and prices in the economy. So, now let us understand the objectives of monetary policy. So, the above definition made clear the objectives of monetary policy. The foremost important objective of monetary policy of a country is containment of inflation. Inflation control is most important thing to be done by the central bank. Inflation means a general increase in the price level of the price level in the economy. Price level should not be allowed to go beyond a particular limit, because any increase in the price level hurts the standard of living of the people, and more so the poor people, because most of their income is spent on the consumption. So, and as you know, inflation is measured by consumer price index, and consumer price index contains most of the consumer items, and they are mostly consumed by poor, and a major part of their income is spent on that, and hence increase in inflation will badly affect them. So, that is the reason why the RBI or any central bank of the world focuses more on inflation and to maintain the standard of living of the people, particularly the poor. Most of the times inflation feeds inflation, because inflation results in pushing of costs upwards. This is known as cost push inflation, and many countries in the world have target rate of inflation. For example, in India, the target rate of inflation is kept at 4% with a tolerable limit of 2% on both sides. That means the inflation should not go beyond 6%, and the inflation should not come below 2%. For example, in USA, the target rate of inflation is only 2%. So, it is the duty of the central banks of the world to keep the inflation at the target range, and any deviation is to be addressed by the central banks effectively. The second most important objective of monetary policy is maintaining adequate liquidity in the system. Let us understand the meaning of liquidity. Liquidity in the banking system means the readily available cash that banks need to meet short-term business and financial needs. So, the short-term needs are withdrawal of cash by depositors, maintenance of reserve requirements, etc. So, any shortage of liquidity in the system results in increase in the short-term interest rates, which are also called call rates. So, excess liquidity results in unproductive cash with banks, and the banks will not get any return on that. Hence, the liquidity should be adequate in the system. It should not be more or it should not be less. And RBI has, for example, a facility called LAF, Liquidity Adjustment Facility, which is operated through two important rates. One is called repo rate and the other one is called reverse repo rate, and we will discuss about the repo and reverse repo rates when we discuss about the monetary policy instruments available with RBI. On any given day, if the banking system is net borrower from the RBI under liquidity adjustment facility, we can conclude that the liquidity in the system is in deficit. If the banking system is a net lender to the RBI, the liquidity is said to be in surplus. And the third most important objective of monetary policy is stability in exchange rate. Exchange rate means the rate at which the domestic currency is exchanged with foreign currency. To understand the exchange rate management, we need to understand the existing exchange rate regime. There are two important exchange rate regimes. One is called fixed exchange rate regime and the other one is called floating exchange rate regime. At present, almost all the countries of the world have shifted to floating exchange rate regime, and India has also done that. So, when in the floating exchange rate regime, the exchange rate of a currency is decided by the market, and RBI has very limited role in controlling the exchange rate. But the exchange rate should not be volatile. So, volatility is a short-term phenomena. In the short term, the exchange rate is influenced by so many factors. In the long term, exchange rate of a currency is determined by the market and that cannot be changed. And the long term exchange rate of a currency of a country depends upon its economic strength and interest rates in the country, inflation, current account deposit, etc. In the short term, factors such as rumors, speculation, disasters, and everyday supply and demand for the currency determine the exchange rate of the currency. So, to reduce the high volatility in the exchange rate in the short run, the RBI intervenes in the market by selling dollars because most of the supply of foreign currency is in dollars. That is the reason why I am using the dollar. And when the rupee is appreciating, the RBI sells dollars in the market, and that will result in increase in the supply of foreign exchange and results in reduction in the exchange rate of dollar. Similarly, when the domestic currency is appreciating, the RBI buys dollars from the economy and pumps in rupees, and make the supply of dollars less. That will result in the depreciation in the domestic currency value and appreciation in the foreign currency value. And let us now discuss about the types of monetary policy. There are two types of monetary policy. One is called expansionary monetary policy, and the second one is called contractionary monetary policy. The objective of expansionary monetary policy is to increase the money supply in the economy by decreasing interest rates, to increase the economic growth and demand for goods and services in the economy. This sort of policy is required when the economy is entering into a recessionary phase. During the recent COVID times, almost all the countries of the world adopted expansionary monetary policies by pumping more currency into the market and by substantially decreasing interest rates to increase demand in the economy. The interest rates reached zero or near zero levels in most of the countries. For example, in US, the interest rate reached zero level. Further, when the inflation falls below the target level, the central bank may resort to expansionary monetary policy. And the contractionary monetary policy means when the target rate of inflation country has reached and the inflation is going beyond the target rate of inflation, the contractionary monetary policy is adopted to discourage people from spending more. This contractionary monetary policy is done by decreasing the money supply and increasing the interest rates in the economy. This will cool off the market and reduce the price rise. And you must be knowing that recently the many countries in the world are in this phase where they are increasing the interest rates, and India is no exception. In India also the interest rates increased, and because we have adopted contractionary monetary policy to contain inflation. And what are the monetary policy instruments available with RBI to implement monetary policy? Let us discuss. So, the first most important monetary policy instrument available with RBI is repo and reverse repo rates. First, let us understand repo rate, and later we will understand reverse repo rate. The rate at which the central bank lends money to commercial banks is called repo rate. An increase in repo rate results in increase in interest rates by banks to depositors and borrowers, and a decrease in repo rate by the RBI will result in decrease in interest rates by banks to depositors and borrowers. The rate offered by the central bank to banks when they park their funds with the central bank is known as reverse repo rate. This reverse repo rate acts as an opportunity cost to banks to increase the interest rates when the reverse repo rate is increased. Let me explain it in more detail. So, the reverse repo rate is the rate offered by the central bank to banks when they park their funds with the central bank. So, when the RBI or central bank increases the reverse repo rate, it is an incentive for the banks to park their funds with the central bank than giving it to borrowers, because if that may be more than the prevailing interest rate in the banks. So, unless the prevailing interest rate is more than the reverse repo rate, it will not be beneficial to the banks to lend money to the borrowers. That is the reason why reverse repo rate acts as a benchmark interest rate. The policy rates are remaining as instruments of monetary policy of almost all the central banks in the world to contain inflation or to stimulate the economy. For example, repo rate in India went up to as high as 13.5% in August 2000 and came down to as low as 3.25% in April 2009. The repo and reverse repo rates usually move in the same direction. If the repo rate is increased, the reverse repo rate is also increased, and when the repo rate is decreased, the reverse repo rate is also decreased. The second instrument which is available with a central bank to implement monetary policy is open market operations. Buying or selling of government bonds by the central bank is known as open market operation. This monetary policy tool is used for expansion or contraction of economic activity. During expansionary phase of the economic activity, the central bank buys bonds from banks to make cash available with banks for lending, and does the opposite during contractionary phase. That means it will sell bonds to the banks and take out the liquidity from the banks in the contractionary phase. The present of course, I have not mentioned about the present repo and reverse repo rates of the RBI earlier. They are 6.5% and 3.3% respectively. The third important monetary policy instrument available with a central bank is discount window lending. Under this, the banks discount their government securities with a central bank to meet their liquidity requirements, and this discounting will help the banks to increase their liquidity. By increasing the rate at which the bills are discounted by the banks with the central bank can discourage the banks from discounting the bills with it. Similarly, when the liquidity is less in the system, the RBI encourages banks to discount their bills and take more cash from it by decreasing the discount rate. But at present, RBI is not offering such facility in India. And the third instrument that is available with the central bank is reserve requirements to implement the monetary policy. Banks have to maintain two important reserves. One is cash reserve ratio, the other one is statutory liquidity ratio. Cash reserve ratio is the percentage of deposits which banks need to keep in cash with the central bank. When the CRR is increased, the capacity of the banks to lend will decrease to that extent. When the CRR is decreased to that extent, the bank's capacity to increase the lending will increase. And SLR is the percentage of deposits which need to be invested in cash, gold and government bonds by the banks. The increase in SLR or CRR, SLR or the decrease in SLR has the same effect as CRR is having on the lending capacity of the banks. That means increase in SLR will result in decrease in the lending capacity, and decrease in the SLR will result in increase in the lending capacity. The present SLR and CRR of RBI, for example, are 18% and 4.5% respectively. Another important instrument that is available with the central bank to implement the monetary policy is marginal standing facility. which is also known as MSF in short form. This is a liquidity adjustment facility similar to discount window lending facility introduced by RBI. Under this, banks borrow overnight funds from RBI against the approved government securities to improve their liquidity. The present MSF discount rate of RBI is 6.75%, and the other instrument of central bank to implement monetary policy is bank rate. This is the rate at which the central bank of a country buy or rediscount bills of exchange or other commercial papers of banks. The bank rate now is aligned with MSF rate, and almost the bank rate has become redundant in India. And the other instrument available with a central bank is market stabilization scheme. The scheme is introduced by RBI to suck excess liquidity created in the system because of capital flows into the country. Huge capital flows sometimes come into the country in the form of FDIs, FIIs, NRI deposits, etc. And this will result in excess liquidity in the system. Hence, the liquidity needs to be sucked by the central bank. Under market stabilization scheme, the RBI sells short-term government securities and treasury bills to banks to suck the liquidity. The rate of interest paid on these securities is decided in auction. Another policy instrument that is available with RBI is Operation Twist to implement the monetary policy. Operation Twist is a monetary policy of the central bank used to bring down interest rates and control investments in the country. Under this program, simultaneous buying and selling of government securities is done by the central government. So, short-term securities are sold and long-term securities are bought when the interest rates are high in the system, and short-term securities are bought and long-term securities with less interest rates are with more interest rates are sold when the interest rates are low in the system. And the difference between OM, that means open market operations, and the Operation Twist is that in open market operations only buying or selling is done at a particular point of time. Under Operation Twist, both buying and selling is done simultaneously. So, that is the difference between Operation Twist and open market operations. So, let us now come to the RBI policy, monetary policy, because that is specific to India. Of course, there is not much difference between the monetary policies of other countries and the RBI. Let us now focus on the monetary policy in India. According to RBI, the primary objective of its monetary policy is to maintain price stability while keeping in mind the objective of growth, because price stability is essential for sustainable growth. As I already pointed out, when the price stability is there, the economy will grow at a healthy rate and inflation will result in the instability in the growth of the country. Similarly, recession is also not good for the country because that will also affect the growth in the economy. Hence, price stability is very, very essential for sustainable growth of the economy. That is the reason why RBI gives top priority to price control, and if there is a clash between economic growth and price stability, RBI prefers price stability to growth. It does not mean that growth is sacrificed to maintain price stability, but price stability is essential for maintaining sustainable growth. The government has fixed a target rate of inflation at 4%, and the RBI has to follow it. And this 4% target rate of inflation has a cushion of 2% on both sides. That means inflation should be in the tolerable limits of 2%, and 6%. If the inflation comes down below 2% or goes beyond 6%, the central bank is accountable and it has to give the reasons to the central government why the prices are not under control. That is the reason why the RBI focuses more on containing inflation. The government has appointed a 6-member monetary policy to review the monetary policy at frequent intervals. This committee consists of so many 6 experts drawn from different fields, and this MPC meets at least 4 times in a year and review the inflation trends, liquidity situation in the economy and economic situation in the economy and take decisions. So if the inflation trends are high, the monetary policy committee will increase the interest rates, and if the inflation is if the recessionary trends are setting in, the monetary policy committee will reduce the interest rates. And we have to understand one important point: the RBI has to take into account the policies of the other central banks of the world also, particularly the US Fed Reserve, which is known as Fed Reserve. The central bank of the USA is known as Fed Reserve, and any increase in the interest rates of Fed Reserve will result in increase in interest rates in India, and RBI will also increase interest rates, and most of the countries in the world follow the policy adopted by Fed Reserve. They factor in the Fed Reserve policy in deciding their monetary policies. Hence, monetary policy, though it is decided by the central bank of a country, it has to take into consideration the monetary policies of other countries also. Thank you very much.